Hi. So welcome to another broadcast, and in this discussion, we want to deal with IAS 1, Presentation of Financial Statement, which is also known as IPSAS 1, Presentation of Financial Statement. So the rule here, or the concept we're going to be discussing here, is applicable both for the students writing financial reporting, corporate reporting, as well as the people writing public sector accounting and finance. Now, when we talk about qualitative characteristics of financial statement, what exactly do we mean? The qualitative characteristics of financial statement are simply a set of attributes that financial statement must have in order to be useful for users. Now, if you remember, you will know that every reporting entity and organization is required to prepare a financial statement. You have the statement of profit or loss and other comprehensive income, which is the same as the statement of financial performance, and it is used to assess the financial performance of the entity for the period under review. We have the statement of changes in equity, which is used to analyze the movement in the shareholders fund for the period under review. Then we have the statement of financial position, which OG is called the balance sheet, which shows the assets, the liabilities, and the equity of the entity to be able to know about the financial status of the entity. Then we have the cash flow statement. The cash flow statement is also there to actually look at the cash inflows and the outflows for the period under review, and to analyze where the entity is investing its cash and where the entity got its cash flows for the period under review. Then definitely the notes to the financial statement. So all these are the financial statement that the reporting entity is required to present. Then we have definitely the consolidated financial statement. Those are all going to be coming from the fundamental that we have just spoke about. Now, for the users of financial statement, which will include shareholders, management, employees, customers, creditors, the government, and other competitors, they are going to be relying and using these information or the financial statement to make various decisions. And so to be able to enable the users of the financial statement make relevant decisions, the financial statement must possess a set of attributes or principles that will enable them to be useful to the users at the end of the day. So the question we then ask ourselves is, what are these qualitative characteristics of financial statement? Now, the qualitative characteristics of financial statements are broadly divided into two, where what we call the fundamental qualitative characteristics and then the enhancing qualitative characteristics of financial statement. The fundamental qualitative characteristics of financial statement will include issues such as the relevance, faithful representation. Then the enhancing qualitative characteristics will include the other qualitative characteristics like timeliness, understandability, verifiability, and the issues relating to comparability. And we'll look at all these things in a moment. So let's take them one after the other and share some thoughts on them. What is relevance? An information is said to be relevant if it will influence the decision of the users of the financial statement. What does that mean? It means that in the presentation and presentation of financial statements, management must include in the financial statement both financial and non-financial information which will be relevant for users to make their decision. That is the first thing, relevance. All information must be included in the financial statement. Now, there are various things that comes in when it comes to talking about relevance, because usually it will depend on the professional judgment of management, because there are certain things management may deem it to be relevant, they will include it. Certain things management may deem it not to be relevant, and so they will not include it. However, generally, issues such as related party transactions, that is IAS 24, must be disclosed and accounted for in the financial statement. And then all other disclosure requirements as per the conceptual framework, the entity must disclose them in the notes so that the information or the set of financial statement will become useful to the users. The second thing is called faithful representation. Now, for the financial statements to be useful, the financial statement must faithfully represent the economic and other phenomenon that it purports to represent. That is called faithful representation. Now, in order for us to assess whether a set of financial statements is faithfully represented, there are three components that we must see in that particular case. The first thing is that the information should be complete, meaning that all the transactions that occur during the year must all be reported and included in the financial statement. Number two, the information must be neutral, meaning that it should be free from bias. What does that mean? Management is going to be exercising professional judgment in making various decisions when it comes to the presentation and preparation of financial statement. The financial statement must be void of bias or free from bias. The number 3 is that the information must be free from material errors. Yeah, you can make some errors though, but material errors. Now, an error is material if it will influence or change the decision of the users of the financial statement. As such, faithful representation means the information should be complete, the information must be neutral, and the information must be free from material errors. These two are what we refer to as the fundamental qualitative characteristics of financial statements. Then we come to the other ones. The next one is understandability. Financial statement must be prepared in such a manner that it will be easily understood by the users of the financial statement. That is why financial statements and notes to the financial statement must be void of various jargons that the users of the financial statement are not familiar with. That is why when you pick any set of financial statement, you see sales, you see cost of sales, you see gross profit, you see operating expenses, you see distribution expenses, you see admin expenses, you see various other things, you see income tax. This is called understandability. So the financial statement must be prepared and presented in a manner that will be easy for the users of the financial statement to understand it. But you see, if you prepare the financial statement, but the financial statement is not provided within the time frame that it is required to enable the users to make economic decisions, then the financial statement becomes useless or meaningless. Hence, the next attribute that a set of financial statement must have is what we refer to as timeliness. It means that having the information available for users to make decision at the time that the information is needed to make the decision. In other words, when an information is provided too early, too late, it makes or it loses its capacity to be useful for accountability and decision-making purposes by the users of the financial statement. So timeliness, information must be provided at the right time that it is needed for decision-making purposes. Not only that, comparability. The financial statement must be prepared in such a manner that when we take the same entity, the financial statement of this year should be compared with the financial statement of last year so that we can assess the performance of the organization and make various decisions. What does that mean? It means that in the preparation of financial statements, management must be consistent in the application of accounting concepts and accounting principles generally. Now, does that mean management will not change the accounting concept? No, they can change the accounting concept, they can change the estimate, but whatever be the case, the same rules must be applied year on year so that we can compare the performance of the organization. Also, comparability means that we can compare a set of financial statement of an entity to another entity in the same industry. However, that comparability can only be done when the two entities use the same accounting concept, accounting estimate, so that that comparison can be done. What are we saying? We are saying that comparability can be achieved through the consistent application of accounting concepts and accounting estimates. Then we come to verifiability. This is a quality of financial statement that helps assure users that the information in the general purpose financial statement faithful represent the economic and other phenomenon that it purports to represent. So that is verifiability. So that is why we don't just take the set of financial statement, but we have the notes to the financial statement, because the notes to the financial statement will provide details on how our sales was like that, why our cost of sales was like that, why our tax was like this, why, because we can verify using that information. These are what you must understand when we talk about the qualitative characteristics of financial statements.